Most people walk into a mortgage meeting and get absolutely destroyed by a number they never saw coming. They have been saving for 2 years. They have found the perfect property. They are ready, and then a lender looks them dead in the eye and says, "We can only lend you this much." And that number is nowhere near enough. Today I am going to make sure that never happens to you. Welcome back to From Zero to Keys on Marcus Lane Real Estate. I am Marcus Lane, and every single day I upload a new episode walking you step by step from zero all the way to the moment those keys land in your hand. If you are not subscribed yet, hit that button right now, because missing even one episode of this series could cost you your dream home. In today's episode, episode 5, I am going to tell you exactly how much you can borrow, how lenders calculate that number, what secretly shrinks it without you knowing, and the legal moves you can make right now to push that number higher before you ever walk into a lender's office. Let us get into it. Here is the number most people start with. The magic multiplier. As a general rule, most UK mortgage lenders will lend you between 4 and 4.5 times your annual income. So if you earn £40,000 a year, you are looking at borrowing somewhere between £160,000 and £180,000. If you and a partner are buying together, lenders will typically combine both incomes. Two people earning £35,000 each gives you a combined income of £70,000, and suddenly you are looking at borrowing up to £315,000. Simple, right? Wrong, because that is just the starting point. And for most people, the real number comes back significantly lower than that. Here is why. Lenders do not just look at what you earn. They look at what you actually keep after everything goes out. They call this your affordability assessment. And it is far more detailed and far more brutal than most first-time buyers expect. Here is what they are looking at beyond your salary: your monthly debt commitments, car finance, personal loans, credit card minimum payments, buy now pay later balances, student loan repayments. Every single one of these reduces the amount a lender is willing to give you. Not by a little, by a lot. A £300 a month car finance payment can reduce your maximum borrowing by as much as £30,000 to £40,000 depending on the lender. Let that sink in. One car payment, tens of thousands off your mortgage. Your monthly outgoings, subscriptions, childcare, insurance, regular spending. Lenders use open banking and bank statement analysis to see exactly where your money goes every month. They are not guessing. They are looking at your actual statements. So that £200 a month you spend on takeaways and that gym membership you never use, they see all of it. Your number of dependents. Every child you have reduces your borrowing capacity. Lenders factor in the cost of raising children as a committed outgoing, whether you like it or not. And finally, your credit score, which is exactly why we spent all of episode 3 on it. A weak credit score does not just affect whether you get approved. It affects how much you get approved for and the interest rate you get offered. A bad rate on a big mortgage costs you thousands every single year. So how do you find out your actual number before you apply? 2 ways. First, use a mortgage calculator. Not just any calculator. Use the ones directly on the lender websites or on broker sites like Habito or London & Country. These give you a far more accurate picture than generic online tools because they factor in your actual outgoings, not just your income. Second, and this is the one I always recommend, get a decision in principle. Also called a DIP or an agreement in principle. This is where a lender does a soft or hard credit check, reviews your basic financial situation and gives you a written confirmation of roughly how much they are willing to lend you. It is not a guarantee, but it is the closest thing to one you will get before full application. And when you start making offers on properties, which we cover in episode 7, having a decision in principle in your hand tells every seller and every estate agent that you are serious. That you are real. That you are not wasting anyone's time. Now here are 3 things you can do right now, before episode 6, to legally increase your borrowing power. Number 1. Pay down your debts, even partially. Remember what I said about that £300 car payment reducing your borrowing by up to £40,000. Imagine what happens when that payment disappears completely. If you have any debts you can clear in the next 3 to 6 months, clear them. The impact on your maximum borrowing is immediate and significant. Number 2. Remove yourself from financially linked accounts. If you have a joint bank account or any shared financial product with someone who has bad credit, an ex-partner, a family member, their credit profile is attached to yours. Lenders see it. It affects you. Contact the credit reference agencies and apply for a financial disassociation. Remove that link before you apply. Number 3. Do not take on any new credit. No new credit cards. No new car finance. No new loans. Not even a new phone contract if you can avoid it. Every new credit application leaves a hard search on your file, and every new monthly commitment reduces your borrowing capacity. From this moment until your mortgage is approved, freeze everything. Here is your homework before episode 6 tomorrow. Use a broker calculator, Habito or London & Country, and get your estimated borrowing figure today. Write it down, then look at your outgoings honestly and identify anything you could pay off or cancel in the next 3 to 6 months to push that number higher. And if you have any financially linked accounts with people who are no longer in your life, start the disassociation process today. Because in episode 6 we are getting into the exciting part. Finding the right property, what to look for, what to avoid, and the red flags that most first-time buyers completely miss until it is far too late. I am Marcus Lane. This is From Zero to Keys on Marcus Lane Real Estate. Subscribe, hit the notification bell, and I will see you tomorrow in episode 6.